First and foremost, I appreciate you guys for taking some time out of your day to come listen. It really means a lot to me. So today's lesson, we're going to be talking about supply and demand zones and kind of some tips and tricks on how to actually trade them. If you have any questions at all, just feel free to drop them in the chat. I'll get to them after we go to each different slide, okay? So first off, we're going to talk about what actually is supply and what is demand, and how is it different from traditional support and resistances, right? Because usually people kind of get these confused and think, oh, support and resistance, supply and demand are completely the same. This is not true. Support and resistance is historical data points that have happened in the past, such as, oh, there's 2 touches at this level on a daily time chart, et cetera, et cetera. Those are historical data points. Supply and demand is not that. These are fresh areas of imbalances that are basically breadcrumbs from big institutional traders that weren't able to get filled all of their size at one specific time. Now, that might sound a little confusing at this moment, but when we get into it, it'll make a lot more sense. So let me kind of reiterate my thing. Support and resistance is historical data points. Supply and demand are fresh zones of imbalances where a lot of limit orders are sitting at to get filled. They're going to be waiting to get filled, whether it be selling orders or buying orders. So a couple benefits of actually using supply and demand, very high probability setups, because if you think about it, this is where the institutions are trying to actually get filled. This is where they're interested in getting filled at. So you already have a high probability because you're basically taking your trades with large money and big institutional traders. So that's a very big advantage, especially if you can find these supply and demand imbalances on larger time frames. It's similar to how support and resistance works. Remember if you find, say, a monthly level on support, that's kind of the same similarities with supply and demand. If you're able to find a large weekly or monthly zone, that's a very, very large area of where buyers and sellers are potentially sitting at and trying to get filled. Also, it really increases your probability. So what I mean by that is, since you already know where the zone is, if you enter at that zone, say, for example, a buy zone, which is known as a demand area. When I say demand, I'm talking about buyers. When I say supply, I'm talking about sellers. So in this specific example, say the price action comes down to the demand area and you see volume picking up, you see making a higher high, it's looking like a potential bounce situation. So you enter your trade, you're going to go long. So you're going to buy a call option. And then you already know your stop loss. Underneath that zone that you drew is your stop loss. So your drawdowns and your risk is very, very little and already basically predetermined. And your risk to reward is very, very high, since you have a lot of reward because you're basically entering with smart money and big money institutions. And your risk is very minimized because as soon as the price action comes underneath that specific zone, if we're talking about demand, and if we're talking about supply, it would have to come above that specific zone, right? So as long as your zone is still validated, you're good to go. But that moment when it becomes invalidated and the price action pierces through it, that is when it becomes invalidated. Therefore, you would then get out of your trade. So you already, in a sense, have your stop loss predetermined before you enter a trade in general, right? So those are some really good benefits of actual supply and demand. So people sometimes fail in trading because they listen to a lot of indicators. They listen to all this different noise in a sense. Some people would have 5 indicators. Some people have 10 indicators. Some people have 15 indicators on their chart, which if it works for you, by all means, that's perfectly cool. But sometimes it can be super, super confusing if you have all these different lines and different things on your chart that in the specific moment when you're trying to enter and or exit, you can kind of get confused because you have to, in a sense, pick through all these different indicators and make sure everything's lining up for you, right? So it is also important to know most of these indicators that you are using currently are lagging indicators. So that's very important to understand because you don't want to just rely on these specific indicators. Say, for example, moving averages. People love to use moving averages. I also use them, but I don't specifically rely on them solely because I understand that they are lagging indicators, right? The only thing that's not really lagging is price action, volume, and VWAP. Pretty much every other indicator that you use is, in a sense, lagging or a little bit behind the actual price action. And also, if you rely solely on one specific indicator and not really have multiple confirmations for you, they can give you false signals. Say, for example, okay, a TTM squeeze is firing. Cool. But if you have no other indications, is the volume stepping up? Is the price action looking either bullish or bearish? You can't just enter a trade simply because of one specific indicator because it's not going to work 100% of the time. So you always want to kind of couple in these different indicators if you decide to use those. Also, you have to realize most of the retail traders pretty much just use the exact same thing. They use moving averages, they use MACD, they use TTM squeeze. They pretty much use the exact same thing. So most hedge funds know this, right? And they kind of can take advantage of that because that's another reason why you potentially get stopped out of your trades a lot because, oh, my stop loss is the 21 EMA, something very common. Hedge funds know that. That's another reason why the market makers pretty much drag the price action down to your 21 EMA. They stop you out and then they just reverse on you. I'm sure that's happened to you many, many times. So this is another reason why you don't really want to just use quote unquote the generic moving averages or the generic indicators. And it's always good to have more information, which is supply and demand. So let me kind of ask you a question. Feel free to drop this in the chat. Do you chase trades after seeing price action rally or drop significantly? Do you tend to do that? Just put up a yes or no in the chat. And then also, secondary question, when seeing this double top, would you continue to take this short? Would you take more puts after seeing this double top form? If anyone is not aware of what a double top is a bearish pattern. So I'm getting some yes, I would take some puts in the thing. Okay, so then my next point is, here's what it actually looks like when it happened. So we came into a supply zone. So this is where sellers were sitting waiting, and we formed that double top. And then this right here is basically where I showed you right about down here. So if you didn't understand that supply and demand was a thing, you would have probably been chasing this trade that's already similar, pretty much already happened. And you then would have gotten stopped out or you would have potentially lost money. So you want to start thinking like an institutional trader. When other people are buying, this is when you want to sell. So up in here in this general region, when people are trying to buy up here, not realizing that there's a supply zone and lots of sellers sitting here, people got trapped here. Same thing right here. People got trapped right here. So when other people are buying and being really greedy, this is when smart money and institutional traders are actually opening positions to sell. They're basically, opening puts, opening positions to sell, whatever it may be. So this is why it's very, very important to try to take away the generic thinking of just because everyone else is buying right now does not mean you have to buy, right? You have to start thinking more like an institutional trader rather than a retail trader. Similar down here. When everyone's trying to sell down here, trying to get filled, right? People are buying. This is when the hedge funds are buying because we're inside of a demand area. So most retail traders are getting trapped right here, thinking they're going to keep going down. The market's going to flush. Everything's going to sell off. Hedge funds are already positioned. They're looking for buy orders. They have limit buy orders right here. And as you can kind of see, as soon as we came into this zone, we ended up getting right picked back up. So try to readjust your thinking and start buying when other people are selling and start selling when other people are buying, especially if you missed most of the move. You don't want to just be chasing that. You just wait either for one, a pullback, or two, wait for the other buys to hit, because there's always going to be zones everywhere. There's going to be supply zones and there's going to be demand zones. If you miss the initial impulse, just wait. There's always going to be a different trade. No need to chase it. So that's just my little spiel on that. And then usually there's 4 different ways of how the market will actually move. There is what is known as a rally base rally, which is creating a demand area. We'll talk about all these in a second. There is a rally base drop, which is thus creating a supply area. Then there is a drop base rally, which is thus creating a demand area. Then there is a drop base drop, which is creating a supply area. There's pretty much these 4 ways is how the market can actually move. And if you're able to identify this, you can capitalize on it, right? So what is rally-based rally? So rally-based rally, I'm sure you've seen these many, many times and you weren't really familiar with what this actually is. So let's kind of break it down quickly. So it's a price pattern that represents a formation of a demand area, right? So it consists of 3 major candlesticks. As you can kind of see here, it's one big old candlestick, one large, pretty much momentum / volume candle. Then there's kind of a basing candle, which if you're not familiar with a basing candle, basing is just basically means an equilibrium. Buyers and sellers are agreeing on price. And then there's one more large volume candle right afterwards. So this is thus creating a demand area, because if you think about it, not every buyer was able to get filled here, right? In this general region, not everyone was able to get filled here, thus creating an imbalance into the market and leaving leftover buy orders sitting there. So we'll talk about all this a little bit later and we'll go into some actual examples, but I just wanted to say this one first. So this is what is known as a rally. So we have a rally up. We have a consolidation period where buyers and sellers are agreeing on price. It's an equilibrium. Then we have another rally. So that is what is known as a rally base rally. One of the ways that the market's able to move. So just some kind of tips and tricks on how to trade this. Usually you want to be mindful of these zones, because this is where the big money is trying to actually get positioned. They're trying to fill themselves here. It's basically, in a sense, like I said earlier, it's kind of like breadcrumbs, right? The institutions are leaving you breadcrumbs for us retail traders to be able to kind of identify that. And if you're able to identify that, like we said before, you're able to get very good entries and potentially very good exits, right? So you should always follow these breadcrumbs if you're able to spot these setups, right? So how would you actually trade this? After the formation of the basing zone, so the basing zone, if the price, so after the rally, so right here, after the rally, the base has already happened right now. So imagine the price action is pulling back into this zone right here. If it holds that zone, that is a good time to buy. That is when you would buy, and your stop loss would be right underneath the base. That is your stop loss, and you would enter inside of this zone if the price action comes back down, right? But if the price did not pull back after the formation of the demand area, then this is when you want to wait and sit and just be patient and wait until we come back into that area, that demand area that we just formed here. And then when we do end up coming back into that demand area, we want to make sure there's volume, and we want to make sure there's candlestick patterns that align with our bias. So if we're looking to be bullish, we want to see higher high structures. We want to see, we want to see a bullish structure. We don't want to see any sense of bearishness whatsoever, or that then invalidates our theses, right? So always trade inside the zones, not outside the zones. Like if you miss this impulse, just wait until it comes back inside the zone itself. So I kind of already talked about this, but this is actually pretty important. Since we're talking about demand areas, a bullish candlestick pattern at the base zone will really increase the probability of winning. By doing this, you'll be able to filter out bad demand zones from the crowd and increase the probability of winning. Just because price action is coming back into either a demand area or a supply area does not mean that you automatically buy right there. You don't want to do that. You want to be waiting for confirmations, because especially in this market, there's a lot of fake outs, because we can come right into a demand area, and then 5 minutes later we could just completely flush through it. So you want to be sure that the demand area is actually a highly probable one, not just a potential false one, right? So we already kind of talked about this. Specifically for the rally-based rallies, it's creating a demand area. So you would then just, if you enter your trade, you would just put a stop loss underneath this zone. And then do not use the setup alone. Always use with multiple confirmations. Same thing with indicators. You want to have multiple confluences on why you are entering this specific trade. If you're looking for confirmations, and if you're only able to find one confirmation, that's not a good trade. You want to have multiple confirmations. You want to have 2, 3, 4. If everything is lining up for you, take the trade. If you're not able to find multiple confirmations, this is not a good setup. Just wait for a better setup. So that's rally-based rally. So the next one is rally-based drop. So we have a large rally. We have a basing period. So pretty much just same thing. We have an equilibrium. Buyers and sellers are just agreeing on price. Then we have a really hard drop. So this is thus creating a supply area. Every time we get a drop, we create a supply area. So then not every seller was able to get filled during this imbalance, and thus creates a surplus of selling orders. So pretty much limit sell orders that are waiting in this area whenever we come back into it. So kind of the same mentality of how to trade rally-based rallies, where you put the stop loss underneath this zone. It's pretty much just flip-flopped, and you put your stop loss above this zone. And when we come into the supply zone, if we come back in, so like to say the price action retraces back into the zone, and there's selling pressure stepping up, this is when you would open puts, not calls, because you're bearish here. You would open puts, and then you would then therefore be bearish, and your stop loss would be right above this zone. So it's pretty much the exact same mentality, just a little bit flip-flopped. So that is rally-based drop, and that is bearish. So rally-based rally is bullish. Rally-based drop is bearish. And then there's two others. So then there's drop, base, rally. So in this case, there is a rally. So we already know there is an imbalance for demand areas. Not every buyer was able to get filled here. So when we have a rally, we're creating an imbalance of demand. So there's going to be a lot of demand and buy orders sitting here. So what this is looking like is there's a downtrend, there's a drop, there's an equilibrium, there's some there's pretty much just an equilibrium of buyers and sellers just agreeing on price, consolidation, and then there's a swift upwards move. So this is creating the imbalance, right? So currently we're balanced, then we create the imbalanced. right? So thus, not every buyer was able to get filled here, and leaving over leftover limit orders of buy orders. They're just leaving leftover buy orders right here. So whenever the price inevitably comes back into the zone, there's going to be buy orders sitting here. And in the exact same way on how you would trade the other demand order imbalance. You would wait till the price action comes into it. You would see if everything's lining good, if the bullish structure is still intact, the volume is lining up, you would then enter the trade. You would go long. You want calls, and then your stop loss would be right underneath this zone. So this is what a drop base rally is. You'll if you kind of look back on your charts, if you look for these specific structures, you'll find them very, very, very often. They happen pretty much every single day because this is how the market actually moves. So this is a drop base rally. This is a bullish structure, so bullish zone. Then we have one more. Then we have a drop base drop. So every time we get a drop, we create a surplus of sell orders, so a supply zone. So we get a large swift downtrend. We get a equilibrium, buyers and sellers agreeing on price. We are balanced right here, so we're in a balanced market. Then we get that sudden swift drop again. Then we create an imbalance in the market. Not every seller was able to get filled here, right? So we have a surplus of sell orders just sitting here. And then whenever the price action inevitably comes back into the supply zone, we would then wait to see if we have confirmation, if bearish, pressure is still stacking up, if the sell orders are good to go, then we would open up puts and have our stop loss right above the actual zone. So those are the four main ways on how to actually pretty much the imbalances. There's rally base rally, which is bullish. There's rally base drop, which is bearish. There's drop base rally, which is bullish. And then there's drop base drop, which is bearish. So pretty much all you really need to care about if it's bullish or bearish is the end result. If it's rallying, you're creating a demand area. You're creating buy surpluses. If it's a drop, it's a supply zone, and you're creating a surplus of selling orders and selling pressure. So these are the four ways of how the market will move. And if you're able to identify these, you can capitalize on these very, very well. So that's pretty much all I have about that. So let's go into some actual real life examples. So I mapped this out today a little bit earlier. So we're going to just talk about how to actually find these zones and kind of just a little bit tips on them. So this is Nextra NEE. So this is from a couple, 2 months, 3 months ago. So this is still current. So just another pro tip: when a zone forms, so in this case a supply zone, when it formed, it will stay here. This will stay here for 3 months. It'll stay here for 6 months. It'll stay here for a year. Does not matter. It will still stay here because these are all limit orders. And whenever the price action inevitably comes back into this, in this box areas, that is when the sell orders will activate. So then you kind of just leave these on your chart. So let me kind of just break it down a little bit. So this is what is known as the first one, rally base drop. So as you can kind of see here, we have a swift rally up. We have a basing period. And then we have that large dropping down, right? So not every seller was able to get filled here, thus creating an imbalance into the market, and which is right here. This is the first one. This is the daily supply zone. So you would then, here, let me try to mark it clean for you guys. 1 sec. You would mark the top of this wick right here as the top of your supply zone. And then you would mark the bottom of this actual body of the candle, not the wick. You don't care about that wick. You care about this wick, not this wick. So you would then draw the body of this one to the top of this wick, right? So you're getting the basing period. Basically, buyers and sellers are agreeing on price here. After that swift rally up, then we based out, and then we're starting to drop, right? So that's creating one imbalance. Now, the cool thing about it is this is where you would want to do your due diligence and look at multiple time frames, right? Because if we only saw the daily, we only saw up to here at $92, but there's also more all the way down to 90 bucks, right? So this is why it's very important to actually look at multiple time frames when identifying supply and demand imbalances. So if we look on the weekly, that same daily that we just found right here, that you don't see that. You do not see that on the weekly candle, right? This is why it's important to always check different time frames, because one time frame will show you something completely different than another time frame. So this is the exact same things happening. We have a rallying upwards. We have a basing period where buyers and sellers are agreeing on price. Then we have that swift sell-off, right? Not every seller was able to get filled here. This is then creating an imbalance into the market. Very, very important to understand. We are balanced right here. Then we are imbalanced. This is what is creating the surplus of orders. This is what's creating all the leftover sell orders. This is what's very important to pinpoint. So as you can kind of see here, the demand, or excuse me, the supply area on the demand, geez, I'm so sorry. The supply area on the daily is a lot smaller than the supply area on the weekly, right? So same exact mentality, you would chart the top of this wick where we're getting the imbalance, and you would chart the bottom of this body of the basing candle, not this candle, or excuse me, not this little wick down here. You don't want to incorporate that for supply zones. You want to incorporate the top wick on the imbalance, and then just the body, the bottom of the body on the basing candle. So that's the weekly. So we have one supply there. We have another supply on the daily, and then we also found one on the 90-minute. So if I go over here, one sec. So this is why it's very important to look at multiple time frames, because we have 3 supply zones in one and in another, basically, right? So this is basically just giving us more confluence that this area of $90 is going to be a very large selling wall. There's going to be a lot of selling pressure coming in here. So if we know that beforehand, if we're in if we're in calls, from the bottom, we already know where our profit target is. We're not going to mess around inside the supply zone. We're going to be taking profits right into the supply zone, because there's going to be a lot of rejection. There's going to be a lot of selling orders here. So we already basically know, predetermined, if we're entering, say, for example, calls right here, we know our stop loss, or excuse me, our stop loss would be obviously underneath where we entered, and our profit target would be in one of these supply zones. We already know that because of this large selling wall right there, right? So this is why the beautiful part of supply and demand is you kind of already understand where your major targets are. This is a major selling wall, right? So then if we identify the 90-minute, this is a little bit harder to spot. So we ended up actually pretty much dropping, basing, dropping again, right? So downtrend, basing, dropping, right? So this is then you would do the exact same mentality. You would chart your little zone from the bottom of this body of this candle right here, and then the top of that wick right there. So then this is then creating a supply zone where leftover limit sell orders did not get filled. So they're going to be sitting here waiting. Can be a week, can be 3 months, can be 6 months, does not matter. All of these sell orders within these zones will be here for however long it takes this stock to come right back up. It will still be here. So that is just some droppings. So basically the drops are creating the supply zones, right? So then let's go over to some demand areas. So let's do from the top down. 1 second. All right, so this is what is known as a drop, base, rally. So this is creating demand. This is creating an a surplus of demand, and not every buyer was able to get filled here, right? So as you see, we have a nice dropping. We have a basing, which is this candlestick right here. Then we have that imbalance, which is this. This is the imbalance. So this is the equilibrium. Buyers and sellers are agreeing on price action on this weekly candlestick. Then we have the imbalance, which is when we actually come right back up. So that means not every buyer was able to get filled here. So then now this is where you would kind of chart it a teeny bit differently. So you would start the zone from the top of this box. So basically the basing box, and then you would chart all the way down to the wick. That is the weekly supply, or excuse me, the weekly demand area. So it's kind of just a little bit of an inverted process from how to chart the supply zones. So like for the supply zones, you would chart the top of the wicks over here on the imbalance, and the bottom of the box, the body of this candlestick on the equilibrium candle, the basing candle. Whereas flip-flop kind of thing, you would chart the wick from the downside, since it's a demand area, and then you would chart the top of this little body right here where they agreed on price. You wouldn't chart any of this up here because this is what actually made the imbalance. This is the result of the imbalance. This is what you would actually consider a weekly demand area B, right? So then, same thing, you want to be making sure there's more demand, and you want to be kind of looking for different time frames, because this is definitely a very wide stop loss. Like if you entered, say, right here, that's a very wide stop loss, technically speaking, if you do the traditional way, right? So this is why it's important to actually look for different time frames, because right here in this example, you have multiple demand areas. We'll go over that in a second here, but then we also found a 4-hour within the same exact weekly candle of demand. So we have another little dropping, a basing, and a rally right there, right? So inside this weekly demand area, we actually have another 4-hour, right? So we have two demand areas within one. So same exact mentality applies. We would go from top of this body of the basing all the way to the bottom of this wick, right? So this is creating the imbalance, because right here in this candlestick, this is the balance market. At that specific time frame in the 4-hour, the buyers and the sellers agreed on price action within this body, right? Then we had the sudden swift rally, which is then creating an imbalance into the market and leaving leftover buy orders sitting here. So then we have a 4-hour demand area forming, right? So then if we kind of keep going higher, we actually made even more demand areas on our way higher. So let's do the 2-hour real quick. So this one's a teeny bit harder to spot, but same exact thing happened. We have a rally to the upside. We have a basing, so a tiny little bit of a consolidation on this candlestick right here. Then we have another rally, right? So this one's a teeny bit trickier to see, but you can kind of spot it right here. So we have the basing where buyers and the sellers agreed on price action with this within this tiny little body on a 2-hour time frame. So this is a balanced candle. Then when we have that swift buy, all this buying pressure, not every buyer was able to get filled here, right? So we then have a surplus of buy orders left over, and we then create a 2-hour demand area. Same exact mentality. You would chart from the top of this box of the basing candle all the way to the bottom of the wick of the imbalance candle. So right there, that's the 2-hour demand area. Then we also have a 90-minute and an hourly, right? So the 90-minute is a little bit easier to spot. It's same exact mentality, rallying upwards. tiny little bit of basing period, and then another rally higher, right? So then same thing. You would chart the top of this little body and then the bottom of this wick. So then that is creating a 90-minute. And then we have one more inside this area. This is a 1 hour. Same thing. We have a rally upwards, we have a basing, and then we have another rally. So there's the basing candle where buyers and sellers agreed on price. And then we would mark the top of this body to the bottom of this wick. So what this means is, yes, this zone is rather large, but the cool part is, since we identified 3 specific areas, now we know how we can do our stop losses. So what I mean by that is, let's just say, for an example, price actions coming within this area, but this first zone is not holding very well, right? So we wouldn't enter this specific area because this isn't holding very well. We would then wait to see how the next area holds. Okay, how is that holding? Is it holding well? Are we making an uptrend? You know, is bullish pressure stepping in? Is the volume stepping in? All that stuff, right? So this way, just because as soon as we come into the demand area, it doesn't necessarily mean, hey, you know, just buy calls. We don't want to do that, because if that's the same mentality, say you buy calls right when we came in and the price action starts actually bouncing down here, right? So you're basically getting you're getting a horrible entry for no apparent reason because you didn't wait. And 2, technically speaking, if you want your stop loss to be true, your stop loss is down there. So that's your entry, that's your drawdown, right? Whereas if you enter down here, you have a much better entry and a much, you know, you're risking a lot less, basically. So just because it comes into a demand area doesn't mean you just automatically buy. That's why it's important to chart multiple demand areas and supply areas, because if the one fails, you have the second one. We have 3 right here, right? So if the first one fails, that's okay. We have the second one. If this one fails, that's okay. We still have this one. If they all fail, then the entire thesis is completely invalidated and you don't enter any calls. It's okay to not enter calls here. You would just wait until we have a better confirmation. And we do have more demand here. So we could very well get invalidated throughout this entire demand area, but this one holds. So it really depends on how the specific price action is that day, because it is very possible that the price action can just completely pierce right through this. If it's nothing like, you know, some large news event happens, or, you know, they miss earnings, any of that stuff, it can very well kind of deviate our theses of our demand area versus our supply area. So anyway, so that's demand in these 2 regions. And then I also have a tiny bit up here as well, just since we're doing a fair bit of examples today. So this is what I mean on what actually happens when we come into demand area. So this is one given time point. This was a demand area right here on the hourly. So we create the imbalance. And then when we came back over it, if you look here, as soon as we came inside of these boxes, look what happened. We had violent up moves. We had a violent rally very quickly on the hourly candle. We basically went up another like $1 or so each time, right? So when the price action came inside of these zones, the buy orders got triggered and ended up pretty much bouncing out, and we started to rally again the rest of the day. In this specific example, this was towards the end of the day, so you didn't really get, you know, much happening. But in this example, when it came over here, we ended up rallying an extra, you know, $1.20 or so. So you already know, technically speaking, where your stop loss is. If you enter, say, right here, your stop loss is right down there, right? So you already have a predetermined stop loss in your head. You don't have to be looking around for something. You don't have to be, you know, searching for a stop loss. You already know where it is. It's right here. That's your stop loss. So that's what happens when we actually come inside of a demand area, if it actually works. Now, not every time it can work. It can just, you know, flush right on through, but this is a good example of what it looks like when it works. So then we also found this on the 150-minute chart down here. So the reason I marked it as weak is because the price actions has already triggered buy orders 2 separate times, right? So this is then becoming weak. It doesn't mean it's completely invalidated just yet, but it's basically telling me, hey, if price action ends up coming down here again one more time, I won't be as confident since this is not a fresh zone, right? Because it's already been triggered 2 separate times. So there's no longer going to be very strong buying orders sitting there anymore, right? So this way, I understand that it's weak, so I'm not going to be super duper confident with it potentially bouncing, and I'll understand if it does end up getting pierced through, right? So when they get invalidated, say the price action comes through, or there's multiple touches at a specific area. In this case, we already have 2. It's already pretty exhausted as it is. So what we would do is we would you always want to refresh your zones. So this is weak. So I would pretty much just completely refresh it, right? So this is completely different from support and resistance. Support and resistance, you're perfectly fine to, leave on your chart for like a week, maybe a week and a half before you refresh your levels. But supply and demand, this is entirely different. The moment your zone becomes invalidated is when you have to delete it. You can't just keep an old zone there thinking it's going to hit that's already been touched like 7 different times and already been pierced through 3 different times. That zone is no longer there. There is no longer any order sitting there. Completely, you would have to get rid of it, right? So that's a major difference between support and resistance and supply and demand. You always want to try to identify fresh zones, and when they become invalidated, you would just cancel them and delete them. So I also have a couple more up here, just since we're doing some examples, just so you guys can train your eyes. If you have any questions whatsoever, kind of just drop them in the chat and I'll answer them in a couple minutes.
Hey, Scrub. Do you post these videos later so we can rewatch them? Because I have to hop off for conference
call. Absolutely. This is currently being recorded, so no worries.
All right, thank you.
If you have anything to do, no problem. Anyway, so then we also have a couple demand areas in here that we found today, right? So if you look here, so we actually, this is a 10-hour zone. So we have a rally, base, rally, right? So then we actually came all the way down. We completely pierced through this 10-hour zone, as you can kind of see here, and completely invalidated this 10-hour zone and this 1-hour zone. So this is an example of where the demand area didn't actually work, but this did. The 90-minute right underneath of it worked, right? So these 2 would be invalidated because the price action came right through it and pierced through it. So these 2 would be invalidated, but this one still held up. It bounced right here, but because it bounced, it is automatically weak because the buy orders were triggered. Thus, this zone is now weakened. It's still going to be here until the price action does inevitably come back inside of it. But I'm just going to label it as weak because I know that we triggered off of it and we ended up having a relatively strong bounce from it, about $2.50, right? So that's an example of where a specific demand zone didn't work out and it got invalidated, but the one below it bounced from it, right? So this is why it's very, very important to have multiple time frames when identifying your zones. And then also, we did create a 90-minute earlier on, but we also created a 45-minute inside of it. So just because this 90-minute right here is weakened and the price action came in right here, there is a 45-minute right below it. So this is still fresh, right? So very important to identify multiple time frames, because the 90-minute I know is going to be weak the next time we come into it, but this 45-minute is still strong and still fresh, right?
Hey, Scrub.
What's up, Ben? How's it going?
Hey, it's going good, man. This lesson's great.
Thanks.
So you got a couple people in the chat just asking about SPY. So when you're done with this, I was wondering if you could do some live supply and demand on SPY. That'd
Already
be like
done.
really
Don't
cool.
worry. One sec. Should be already charted here. Oops, not the right one. Was it? I know I charted them last night. I think I did at least. One sec. I must have charted on my TOS. But yeah, I'll do live stuff right here for you real quick.
Yeah, no rush, no rush. It's going great. I love the lesson.
Thanks. But yeah, for just to answer your guys' question, this works extraordinarily well for indexes like supply, SPY, QQQ. It works good for futures. It works basically for anything, because if you think about it, this is just basic economics 101, supply and demand. It works for anything. It works for equities, it works for crypto, it works for Forex, it works for anything you can think of that has a chart, it will work for it. But it works extraordinarily well for actual indexes, because they will happen pretty much every single day. So this is not fresh. So let me do one sec. Let me look at the other questions. So zones can be formed during pre-market. Yeah, zones can be formed during pre-market and after hours. This is why it's very important to have pre-market and like after hour time frame on your charts, because you're able to see those on your charts. Now, fun fact, when charting supply and demand on indexes such as SPY and QQQ, if you're looking for the pre-market zones, like the proper zones, I would highly recommend charting ES, which is the futures for SPY, or NASDAQ, which is NQ, because the reason being, you'll notice if you compare the overnight futures with the actual ETF such as SPY or QQQ, the price action is different. It will show you similarities, but if you compare the futures to the actual ETF, they're different. So if you look at the exact same, like if you try to do the exact same zones and compare them from SPY and ES, they will be different. And they're not going to show you the most accurate information. This is why I would highly recommend charting via the futures, like the NASDAQ and ES, because you'll get the most accurate information on your zones. Just kind of a, just a tip for that. All right, so usually what I end up doing, I'll just kind of run over it real quick on how I would make my supply and demand levels for the specific day. So I'll start off on the larger time frame. Usually, depending on how I feel, I usually do the quarterly. We already kind of found something right here on the quarterly. Rally, base, drop, right? So this is a 3-month candle. So what we would do is bottom of this, top of this, and this then creates a large ass supply zone, right? So we know next time we come into this area of 430 region, there's going to be some sell orders. So then we would just mark it as such. Okay, just so we remember, this is a quarterly, right? Now, there's going to be multiple supply zones inside of this, obviously, because this is very, very wide. But we know overall that there's going to be sell orders within this area right here. So nothing really down there, because I don't really think SPY is going to drop 100 points, so I don't really care about that. Then we would do the monthly. Same thing. We have rally, base, drop. So then we have another one right here. Boom, boom. So bottom of this box, bottom of this body for the basing period, and top of the imbalance itself. So then this would be a monthly. So then we have, so far we have a 3-month and a monthly inside of each other. Nothing, I mean, you can consider this technically as a demand area if you think about it, since it is, but I'm not going to just worry about it because it's 100 points off. But if you think about it, this is a rally, basing, rally. So that is then creating an imbalance right there, right? But just for sake of time, I'm just not going to chart down here because, I don't think SPY is going to drop that much just yet, right? So then see if we can find anything else that kind of makes sense. Same thing down here. just for the sake of argument, so it makes sense to you guys. So we have a drop, base, rally. So the moment you start identifying these, it will become so much easier. There's only 4 ways how the market can really move. And if, as long as you can identify that, you're able to capitalize on it. So drop, base, rally, right? So then this creates an imbalance right there. And then the moment we come into it, if you look on that candle, like if you look at this candle right here, the moment we come into it, we get triggered with the buy orders, right? So this is why it's super important to chart on different time frames. So then this would be, I don't care about it because it's already been tested, no worries. Then we go down to the daily, see if we can find anything else that looks spicy. We do have a, also usually when gaps happen, I like to kind of just be mindful of them and kind of just chart them as such, just so I know for future reference that there is gaps. Same thing with this one. Usually gaps like to be kind of filled, can be a day, can be a week, can be a year. They are considered, technically speaking, imbalances to the market. So usually they will get filled. It just depends on how long they can get filled. So just kind of use that as a pro tip. So there's nothing really else I'm kind of spotting right here. So then I will just kind of keep going lower, see what else we can find. So here's another thing. Well, actually I spot a couple ones actually. So we have a dropping, we have a basing, we have a rally, and then after that rally, we actually based out again and dropped, right? So then we ended up creating a supply zone inside a monthly zone. So you would chart the bottom of this candle, the basing candle of the body right there, and then the top of the wick of the imbalance. So then you would just chart it as such. Okay, this is 10 hour just for future reference. Boom, boom. And then you would just keep going lower, keep going lower. I saw another one right here. So this is another one that was tested already and now invalidated. Because if you look, this was once a 10-hour supply zone right here. And we ended up invalidating it. So just same thing. This is very important. Just because we come inside of a supply zone does not mean you just automatically get puts, because if you look at it, it technically speaking worked out, but it worked out like $2 later. So this supply zone was, the supply zone was invalidated. So this is a reason that we don't just be eager and just, jump into zones just because we're coming into zones. So this is invalidated, so we would get rid of it. And this one's more of a fresh zone. If you see right here, right there, that's a fresher zone. So we have a rally, base, consolidation, drop, right? So that is creating a supply zone from the bottom of this body of the basing candle and the top of the imbalance of the wick right there, right? So this is a fresh zone. So the next time we come into 430, let's just call it 437. Next time we come in there, there's going to be a supply area just kind of waiting, and there's going to be sell orders. So then you would do 10 hour right there, right? And then also we did just create, we're starting to create, so this isn't looking very pretty just yet on the 10 hour, but I can almost guarantee you somewhere within this zone, there's going to be a demand area. So I'm going to leave this blank for now, and I'm going to keep doing my time frame due diligence, right? So I don't see that here on the 6 hour either. I do see something else here on this time frame though. So we did find it on the 10 hour. We also spotted another one right here on the 6 hour right there. So these are considered weak. So the 6 hour is weakened. So I would label it as such. This is technically speaking already touched if you look at it. So we had a rally, kind of a little basing, and then another little drop, right? So this basing candle ended up getting touched again. So this supply zone right here got touched again. So this would be considered a 6 hour weekend, right? So it's still current, technically speaking, but you don't want to, because usually kind of a rule of thumb, just for another tip, the larger the time frame on the supply and demand zones, usually the more touches you can get out of it. So what I mean by that is, okay, say it's like a daily, a weekly, or like a monthly time chart, usually you're able to squeeze out like maybe 3 touches, potentially 4 touches out of that specific zone before it becomes exhausted, right? Whereas if it's on a smaller time chart, say like an hourly, you know, like 2 hour, 30-minute, any of that stuff, like a shorter time frame, usually you're able to squeeze up maybe two touches at that time, at that imbalance, you know, the supply or the demand area, before it becomes exhausted and pierces through. So kind of just use that as a pro tip. When you find them on the larger time frames, they hold more merit. When you find them on the shorter time frames, they hold less merit. So nothing really still here. So then we kind of just keep going down, see if I found anything else. So here's one right here. So we have a dropping, basing, rally, right? So then this will be becoming a demand area right there from the top of this box, excuse me, this body to the bottom of this wick, thus creating a imbalance, and buy orders are sitting there. So we would label it as green, green for buyers and red for sellers. And we would just say, okay, this is a 5 hour, boom, boom, boom. And then hold on, let me see some questions. Do you ever use volume profile for extra confirmations of zones? Yeah, you can do that, definitely. Extra confirmations are always better. Let's see what else we can find. So we do have a tiny little bit of something there, but it already did get touched. So that would be considered something, but it did just get bounced off of. So we might be able to find it on something else. Let me see if we can find it. There we go. It looks better on this time frame. So this is a 4 hour demand area. So the one that we saw before, I believe, was on the 10 hour. So we knew something was around this general region, but we're starting to kind of pinpoint it on the smaller time frames. Right. So here's something right here. We have a dropping, we have a basing, and we have a rallying. Right. So this is then creating a fresh 4 hour zone. And then nothing really up here. Just trying to go a little bit quick just for sake of time. And then 3 hour. Because I know there's definitely going to be more zones in here. So inside this 10 hour, there's actually a smaller 3 hour if you look at it. Right there, right there. So boom, boom. So we actually have multiple supply zones inside supply zones. So this is giving us extra confirmation of, you know, just a large selling wall. So then we'll kind of just label that 3 hour. So then let's see if anything else is popping out of this. So we did create a supply zone yesterday right here, but if you look, it ended up being invalidated. So then we would just get rid of it. So inside of our 4 hour, we have 2.5 hour, right? So boom, boom. We have a drop, base, rally, and then make it green just for visuals, just so I remember next time. Do a 1 hour, 50 minutes, boom, boom. And then see if we can find anything else within here. We have, what was this, 10 hours? So we have a 90-minute inside the 10 hour. And we also created this one over here too, if you look. But this one got invalidated because we have 2 touches. So I'm not even going to chart that one. I'm going to chart the fresh one right here. It might look a little confusing at first, but I promise you, once you get your eyes trained to these, you know, finding the imbalances, it's really, it's not too bad to actually spot them truthfully. So it might take like a week of practice or so, but after that first week, and you can kind of identify the 4 different imbalance moves, it'll be a lot simpler for you guys, and you'll be able to find these key zones very quickly. So that's a 90-minute. Anything else? So we have a 4 hour, 2.5 hour, and an hourly all within each other. So this is thus creating a very large demand area for me. So I would not short into this. I would not short this whatsoever. People, like I said from the beginning of our presentation, you want to change your thinking. People are probably going to start shorting down here, not realizing there's a shit ton of buyers sipping in right here. I would not short down here. I would be looking to long and buy down here, right? So kind of keep that in mind. When you see multiple zones, you know, over each other and overlapping each other, you don't want to do the other bias. So like people are going to, like retail traders are probably going to be like, oh geez, it broke out of this, let me start selling and let me start, you know, buying puts. This is where big money is already sitting. They're looking to buy all your stuff that you're selling. So kind of keep that in mind. So anyway, we have multiple demand areas inside demand area. So I would be looking to long here, not to sell. So let's see if I can find anything else real quick. 65 minutes, see how 65 minute looks. Here's one that just got touched the other day. Here's a 45 minute. If you look here, if you look in pre-market, this is why pre-market we ended up kind of flushing a little bit, because if you look, we created a little imbalance right here. And as soon as we came into that area during imbalance, excuse me, as soon as the price action came into the supply imbalance, we started selling off. So that's another reason why we sold off today. I'll do a little bit more, but if you have any more questions, feel free to just drop them in the chat. I'll answer them before we end our session today. Whatever else questions you have, feel free to answer them now, or excuse me, ask them now.
So Scrub, this is a quick question I had. Do you ever find it hard to update your supply and demand zones when SPY or QQQ, like, because I know you say you usually chart like the ES, right, to get more accurate levels, but when it gaps up and stuff like that, or gaps down overnight, do you find it hard to find new levels and stuff like that, or what do you do in that kind of, because I know you have that level right there and it came up into it and immediately sold off, but like I don't know what I'm trying to say, but is it harder for you to update your zones when you see stuff like that?
Yeah, but if you think about it, this is why I'm talking about charting the actual ES, not the SPY, because this stuff right here, you don't see that on the futures. You see actual price action on the futures.
Got it.
You don't see this little gapping up on futures. You see pretty much price action doing this, right? So that's why it's better to like chart actual futures than SPY, because like you're not really going to see pretty much whatever the hell happened overnight. You're only going to see potentially the following days, or excuse me, the prior days. And another reason why we sold off is, I forget what time frame that was on, but we also have another one right here. So we actually had two supply zones coming right here, right? And then we just formed this one today. So for whatever reason, if we ended up kind of coming right back into this during power hour, we would not be looking to long yet. We would actually be looking to short, and our profit target would be down here, right? The only way that this is for my specific rule, if it comes into a supply zone, I don't look to long it until it comes above it, right? So this way, I'm only looking to short inside the supply zone unless it becomes invalidated, then I'll look to long. Same thing down here. When we come into a demand zone, I am not looking to short it. I'm looking to buy calls. The only reason I would buy, puts is if we come underneath of it and it invalidates. Does that make sense?
That makes perfect sense.
Awesome. But yeah, that's just kind of how I make my levels and my zones. I pretty much just go top down. I just try to find everything I can, from monthly, weekly, daily, all the way down. Usually the lowest I like to go for intraday stuff is probably like 5 minutes, maybe 10 minutes. Because when I've back tested the supply and demand areas, I've realized that like the 5 minutes and below aren't very strong. Let me see if I can find one that just for an example's sake, off the top of my head, there's definitely some, but just for sake of time, I'm not gonna just like pinpoint it for you guys. But just trust me, don't make supply and demand imbalances underneath the 5 minute. It's not worth it. It's most of the times they get invalidated and just pierce right through. So usually I would recommend preferably staying above the 10-minute time frame. and then going all the way up to pretty much the monthly, or if you want to, even the quarterly. I usually chart upwards of 3-month candlesticks, so the quarterly. But if you guys have no more questions, that's pretty much how I like to utilize supply and demand. Just for a quick another little thing that I like to do is, okay, since we already have our supply, we already have our demand, the way I like to trade it is I only trade here or here, right? The reason being is because this is where big money is sitting. This is where big money is sitting. Who's sitting in here? Retail traders. Who is sitting in here? Choppiness. This is all chop. This is shit. You don't want to trade this. You want to trade here or trade here because it's highly probable. This is where your risk is minimal because your stop loss is right there. Your stop loss is right there. If you trade up here, your down draw is increased, right? If you enter here, technically speaking, your stop loss is down there, right? So you're basically trading with retail and it's choppy in here. Whereas if you trade in the supply zones or in the demand zones, you have a much higher probability of success because big money is entering. They're looking to enter during these timeframes, or they're looking to sell during these timeframes, right? So kind of just keep that in the back of your mind if you want to utilize supply and demand. Now, I'm not saying breakout trading is bad, or scalping or any of that stuff is bad. I'm just kind of give you a different point of view to think about. But anyway, does anyone have any more questions before I end session today? I really, really appreciate you guys for listening. I'll upload this video to YouTube in a couple hours. And I'll be doing more sessions like this probably once a week. So if you have anything you would like to listen about, or anything you want to learn about, just feel free to either DM me and we can chat about it, and I'll create a lesson plan on it. Other than that, I really appreciate you guys for listening. Thank you again. If you have any questions or ever want any, want to learn further, I do offer mentorship sessions. I have spots available next month. So if you would like to book something, feel free to reach out to me. Thank you again. And I appreciate you guys for listening.
Thank you, Scrub. Great lesson as always.
Thanks, man. Hope you learned some stuff, guys. I'll see you guys later. Enjoy the rest of your day. And have a great weekend.
Have a great weekend, everyone. Going to end the call now. This will be posted up so you can rewatch it.
Take care.